It is an unprecedented stimulus package that the White House is proposing, $1.3 trillion in relief for businesses and workers whose revenues and wages are grinding to a halt. The Treasury Secretary Steven Mnuchin putting forth this proposal on Capitol Hill today to Senate Republicans. It includes, according to a senior administration official, $550 billion in direct payments to Americans or tax relief, up to $300 billion in small business aid, and up to $100 billion in targeted industry relief. And add to that an estimated $300 billion in deferred tax payments. The Treasury Secretary said the benefit to the American economy is greater than the cost.
In different times, we'll fix the deficit. This is not the time to worry about it. This is the time that hardworking Americans are impacted by government decisions. That's when the government has to step up.
This proposal is a third package that follows an $8 billion funding package that helps agencies, and a House bill that passed last week that provides an estimated $105 billion in paid sick leave to an estimated 40 million Americans. Senate Majority Leader Mitch McConnell today said that the Senate would vote on that bill. Federal regulators are also working to relax post-crisis bank rules to allow banks to continue lending to businesses as their earnings deteriorate, and also readying a loan backstop program that could be unveiled later this week. The Department of Defense tonight said it is providing masks and ventilators and testing facilities and is considering deploying the National Guard to aid in the coronavirus effort here. Of course, after weeks of mounting concerns about the spread of this virus and the economic fallout, the effort across Washington is now in full force. Brian?
All right, Kayla, Tausche. Kayla, thank you very much. Now let's get down to Bob Pisani, who's at the New York Stock Exchange. He's here to talk about markets, the consumer, and I assume maybe $1 trillion plus bailout as well, Bob.
It moved the markets, Brian. The Dow swung in a 1,500-point range again today from its low right after the open to its midday high. But this time, the rally held, and I think it held because there was plenty of stimulus talk you heard from Kayla, from the White House, both houses of Congress, and the Fed establishing a commercial paper funding facility to buy unsecured short-term debt issued to raise funds. Today's rally felt very tentative, but it was a rally and it did hold, and it came on lighter volume than usual. That's interesting. Volatility has also flattened out a bit. I say flattened out because the VIX remains extremely elevated, but it's been relatively flat the last several days. It was nice to see the banks up as yields shot up dramatically at the end of the day. As Brian told you, Regions Financial, JP Morgan outperforming the market for the first time in a while. But defensive stocks still led. This has been the story. Outsized gains from consumer names like spice maker McCormick and Hormel Foods, General Mills at new highs, Clorox also at a new high. After a dismal few days, large retailers also bounced back, including Urban Outfitters, TJX, and Best Buy, but all still down double digits for the month. Finally, there's talk that both Boeing and the airlines will be part of that massive stimulus program you heard from Kayla. Government help sounds good, but none of those stocks rallied. What's the story there? Traders tell me there may be lingering concerns from the financial crisis when bailout programs for autos and some insurers wiped out the equity for shareholders. And that could be an issue, Brian. Back to you.
I certainly could. Bob Pisani at the NYSE. Bob, thank you very much. So Bob mentioned the commercial paper market. So before we get into more on the Fed and what they're doing, perhaps it's helpful to highlight first what exactly the commercial paper market is. You're going to be hearing a lot about it. Well, at the core, CP, as you're going to hear it called, is really just a fancier term for short-term loans. Loans of maybe a few weeks or months or even shorter that can help companies and small businesses do critical things like make payroll or buy the goods they need to stock their shelves. The purpose of the CP market is so millions of companies don't have to go get formal bank or small business loans every couple weeks and months when they need short-term cash. Put very simply, it's the grease on the wheels of cash flow. So how big is the commercial paper market? Well, it's big. The latest data shows it is over $1 trillion, although, believe it or not, that is actually less than it was before the financial crisis. Let's bring now back in Steve Liesman. And Steve, tell us more about the Fed, the CP market, and why it is so key to keeping that grease in the wheels of the market flowing.
Yeah, great explanation there, Brian. And it was a very busy day for the Fed What happened is the companies and the investors were not buying that commercial paper. And as you described, it's so critical to business that if they can't get this commercial paper, well, really, they can't operate. And the reason, of course, is because money markets are the ones who buy a lot of that commercial paper. They were afraid of getting drawn down. There was apparently outflows from those money market funds. So a big day for the Fed, answering the call of many in the market to come in and backstop this commercial paper or CP market here. Let's look at what the Fed did. One, they created the commercial paper funding facility. That's the same thing they created back in 2008, same name, pretty much the same terms. But this time the Treasury provided a $10 billion backstop to help the Fed in case there were losses there. It could buy up to $700 billion of that $1+ trillion that Brian was talking about. Some of the paper is not included in there. In addition to that, the Fed is going to do another complicated thing, $500 billion of repos for the rest of the week. The reviews on the commercial paper were not that great, Brian. One person said the Fed's new commercial paper facility replicates its action in 2008. Welcome, but not enough. The administration's $850 billion bill is a start, but the focus on a payroll tax cut is a mistake. Another senior market participant I talked to said, it's too punitive right now. That's the rate they're charging. Nobody's going to use it. The commercial paper market is still not functioning well. Others said it may eventually function well. Brian, here's what's going on in the credit markets. The economy is being shut down because of the virus, because of actions to stop the spread of the virus, but nobody figured out how to pay for it. So what's going on right now is there's concern about default and risk in a lot of credits right now. And almost every actor in the financial industry is trying to make sure that they're not stuck with those credits that will default or be at risk. And that's why what the administration is doing is so important. That's why what the Fed is doing is so important. Try to find a way to liquefy this economy and float it over the 2 months that it may be shut down because of this virus.
Very quickly, Steve, has anybody done, maybe you've done it, the math on the total that we've talked between the Federal Reserve, the New York Fed, commercial paper, repo operations, and possibly this $1 trillion stimulus plan they're talking about? Are we at like $3-4 trillion?
We could be, Brian. The Fed will purchase $700 billion. Look, there's a difference. The reason why the counting is a little weird is because the Fed puts $500 billion on offer in the morning in overnight repo, but the market only takes down about 120, 150 of that. Comes back in the afternoon, puts $500 billion on offer for overnight repo. The market's only taken down 10, 15, or 20 of that right now. The CP market, it could be up to $700 billion according to the rules of the offering, but we don't know how much they're going to take. I think if you take the $700 billion the Fed's going to purchase, the many trillions in repo, we are into multiple trillions of dollars of available funds from the Fed to backstop the financial system right now.
Basically, the entire one-year tax receipts of the federal government so far. Steve Liesman, thank you, Steve. We appreciate it. All right, now let's bring in Guy Adami and Dan Nathan, both here at the Nasdaq. Guy, all right, we'll start with you. In a time of incredible stats, I got another one for you from the bond market, because I know you like to talk about bonds. This one courtesy of National Securities. Today was actually the sharpest one-day move for 30-year bond yields since the year 2000. What does that tell you?
Yeah, it tells me a lot. But let me just say quickly, if you allow me a minute or so, you know, if you've watched the show for the last 13 years, I'm clearly been the half-empty person throughout the entire thing. And that's just the way I was raised on Wall Street. You know, what can go wrong will go wrong. But I'm going to be the half-full person today, because I know, as painful as this is for everybody watching, we're going to get through it, and we're going to get through it on the other side better than we were when we got here. That's my absolute belief. With that said, as you know, my concern all along has been the bond market. And I would be willing to bet the people that actually understand this stuff would have wanted the stock market to close unchanged today, or even slightly lower, and the yields in the market not move as precipitously as they did. You know, the bond market to me is a big concern. So there's absolutely some solace in the fact that we traded down to, in the S&P 500, effectively the December, whatever it was, 24th low of 2000 and I guess it was 18 or so. We traded down to that level and bounced. That's a good thing for you technicians out there. But again, I'll say it again. The move in the bond markets are scary. Treasury should not move like they're moving. Now, if we can get them to stabilize, the point I made last night, if they can stabilize at whatever that yield is, maybe it's 1.25% in the 10-year or thereabouts, that actually could be a really good thing. And if you recall, on the way down, I said, listen, there's going to come a point of diminishing marginal returns in terms of yields that if we hit it, the stock market won't like. And on the way down in yields, that was 1.4%. So it stands to reason that on the way up, 1.4 better be resistance.
Oh, we're going to find out. All right, let's go now to Dan Nathan. All right, Dan, I think that most of the questions you're probably getting on Twitter and social media, or as I am, what are the key signs of capitulation, a market bottom, and are we seeing any of them now?
Well, we are to the effect that just the velocity of the down move in such a short period of time is really unprecedented, down 30% peak to trough in a month here. And, you know, we're in this market, Sully, right now where it's kind of one step forward, two steps back in a way. You know, yesterday was the biggest point decline in the Dow Jones. And today, you know, we made up a little more than half of that. So when Guy was talking to some of those technical levels in the S&P 500, that December 2018 low, we stopped yesterday just above that. That's great. But if we fail, then the next level below that would probably be the breakout in November of 2016 after the presidential election. And that range is down below 2,200. So we might have this support pocket between 2350 and 2150. And I think that would be significantly oversold. But then I think you want to look at it on the single stock level, right? And so we know that a lot of stocks have just been absolutely decimated in such a short period of time. Well more than, let's say, the market would tell you with the S&P 500 down 22%. We know we can look across transports and energy and a whole heck of a lot of other places where stocks are down 40, even 50%. Here's the one thing that I'll tell you would be a sign of capitulation in the near term would be Microsoft and Apple, two of the largest market cap companies here in the U.S., but also in the world, have really outperformed on the downside. I think Apple is down about 13% on the year. Microsoft down 7%, down obviously more than that from their highs, but they're still up meaningfully year over year if you go back and look at March 17th levels 2019. And I think investors might be waiting for them just to kind of give up a lot of that, and then you might kind of feel a little bit of capitulation, and then you might start seeing some of these other names that have been hit much harder, maybe in the industrial space, maybe the financials, maybe the transports, start to outperform as we get a little worse. Those would be some of the things that I might look for at capitulation. And then one last point, I just got to go back all the way to 2001. You know, that peak to trough decline in that recession was 50% from the March 2000 highs to the lows in October 2002. And I'll just tell you, in that time period, there were 3 rallies off of lows that were greater than 20%. So I think what my point here is that you can have these vicious bear market rallies here, and it doesn't really mark the bottom. You need to see a confluence of events. You need to think about some of the stuff that Guy was saying in the credit markets. You need to see this fiscal and monetary stimulus work into the economy and let people feel a little bit better about the financial market. So I guess the last thing I'll just leave you with is time is going to be a really, really important part of a bottoming process, and capitulation might be near term.
I want to stick with you, Dan, get a follow-up before I go back to Guy. Do you anticipate when we get this bottom, you've been highlighting the MAGA stocks, the Apples, the Microsofts, the Googles, that when the market does turn, a lot of people are saying, well, what should I buy? Do you think that the leaders of the previous rally will be the leaders of the new rally once or if it comes?
Yeah, I suspect so. I think one of the headwinds to those names in particular was regulation. I don't think we're going to see that anytime soon. The other one is, like, look at the moats that these companies have with their balance sheets. Look at they have with their market share. To me, these are companies that will not be bailed out. So unfortunately, if we go back and look at history, some bad investments were buying those names on the bailout when we go back to the financial crisis. Now, long term, they ended up being good investments, but that's not what you want to make a portfolio right here of if you're thinking about getting some kind of free cash into the market right now. You do not want to buy beaten up retailers. You do not want to buy beaten up airliners. Not for the long term. Near term, you may get some short squeezes, but to me, I think dollar cost averaging into those massive tech names that have those monopolies, I think that's probably the way to do it. And the QQQ is a way to do it because we know that those four stocks, Microsoft, Apple, Google, and Amazon, made up about 40% of the Nasdaq 100 just about a month ago.